Okay, so we left off right here where we're taking this average for this pension. And when we're taking, oh, I just noticed I forgot these zeros. When we're taking an average, we want to add up all the total incomes, all of these right here. And then we're going to divide by the number of incomes, and we're taking the last 5 years' salary. So we're dividing by 5. So go ahead and take a second and do this on your own calculator to make sure that you get the total. And then pause the video here for just a second. And then you should have gotten 489,300 for all those salaries added up. And then we're dividing that by 5, and that should give us an average salary of $97,860. Then we take that average salary and multiply it by the percent that's decided on by the company and the years of service. Why would a company do this? They're trying to reward the people who have stayed longer at the company. So the longer the number of years that you've stayed with the company, the better your pension is going to be. So this is 0.0175%. And then he had 28 years of service. So you multiply by both of those numbers and you get $47,951.40. So that's an annual figure. That's how much pension he's going to get in his retirement. But I want you to imagine that if you were used to making 99, 100, 105,000 a year, and suddenly you're down to less than half than that, picture how much you have to learn to live on. And so that's why obviously there's going to be a little Social Security, but you have to really save outside of your pension to make sure you're going to be okay in retirement. All right, now let's talk about unemployment compensation. During COVID, there was a lot of people receiving unemployment. So this is done by dividing a 26-week average or 2 quarters. So in this case, we're being given the 2 most recent quarters. So we're adding the 19,574 to the 21,974. And then when we get those 2 totals, we're then going to divide by 26 because 2 quarters is half a year or 26 weeks of the year. So we want to get a weekly average, a weekly unemployment amount, which is how unemployment pays you in case you're only out a couple weeks. They only pay you weekly. All right, so totaling that up, take a second, pause the video, make sure you get the total. And then dividing by 26, you should have gotten $15.98. And so that's going to be the weekly average pay. And then we only get paid 47% of that weekly average pay. So take the 0.47 of that, and that's 751.06. But in California, we have a max unemployment of 450 per week. Whoa, look at how much less that he would actually be getting. But so the answer would be 751.06. But if you were in California, your max would only be 450 per week and you'd have to live on that. Why do they give you so little? Because they're trying to make you go back to work. They want you to find a job. All right, for these last ones, we're looking at a couple different scenarios based on the Social Security tax. Social Security tax is 6.2% of your earnings and Medicare is 1.45. But Social Security caps out at 142.8. This is actually going to be the number for 2021 next year. And this year it was like 137.6. So every year this max cap goes up slightly based on cost of living going up. So if Maddie earns under the limit, then we just take 0.062 of her earnings for the Social Security. So 0.062 of the 140, she's going to pay $86.80. Okay, she's still under the, it's under the max limit for Social Security, but Medicare does not have a limit. Medicare is just 0.0145 of whatever you make. So this one's always easy to remember because you just take 0.0145 of what she makes. So 2030. So think about this. This is money coming out of your paycheck that goes to the government for taxes. These are federal taxes, so that later someday you can receive the benefit of Social Security and Medicare when you need it. What is FICA? It is Social Security plus Medicare tax together. So we're going to take the 8680 and we're going to add that to the 2030. For total FICA of 10,710. Make sure you're doing these on a calculator to check me. Make sure you understand how we're getting these so that you can do it on the test. So FICA is what you would actually see as a paycheck deduction. On your paycheck, you see a little line called FICA, and at the end of the year, this is how much came out of Maddie's paychecks during the entire year. This was split up to every month, and this is what came out total for her Social Security and Medicare taxes. Now, what happens if Maddie earns exactly the base limit, this 142,800? If she earns exactly the limit, we still take 0.062 of her earnings. Take a second to calculate that. And you should have gotten 8853.60. How'd you do? And then again, Medicare is always 0.0145 of that limit. Doesn't have any, min or max limits, 0.0145 of the 142,800. And so 2,070 and 60 cents. And then what would be her FICA? We take both the Social Security and the Medicare and add it together. So the 8853.60 plus the 2070.60 equals 10,924 and 20 cents. Double check me on these numbers, you guys. Make sure you add them, make sure you know how to get them. All right, what if she earns over the limit? So why is there a limit? What does that mean? It means that the max she can pay is 0.062 of the limit. Even though she made more, I can go back up here because we already calculated this. This is the maximum that she's going to pay. Even though she made more, this is the max she will pay. So Social Security has a max that you will pay no matter how much you earn. But there is no max on Medicare. So I'm going to do the actual income here, 0.0145 of the 145 income that she earned. There is no max on Medicare. So take a second to put that in your calculator. And the two of these together, 8853.60 plus 2102.50 is 10,956 and 10 cents. Because FICA is both of them together. And I think that's our last one. Yay! Do you feel ready for the test? I hope so.